Hey everybody, Tim Ulbrich here, and thank you for listening to the YFP podcast, where each week we strive to inspire and encourage you on your path towards achieving financial freedom. This week, Tim Baker and I talk through a topic which we have not yet covered in detail on the show, and that is long-term care insurance. During the show, we discuss what long-term care insurance is, what it does and does not cover, and common misperceptions surrounding these policies. We also discuss 5 key considerations when purchasing a policy, including when to purchase one, what to consider in terms of a monthly benefit and deductible, whether or not it's worth having inflation protection on a policy, and how long to determine the benefit will be paid. Before we jump into our discussion around long-term care insurance policies, I recognize that many listeners may not be aware of what the team at YFP Planning does in working one-on-one with more than 280 households in 40 plus states. YFP Planning offers fee-only high-touch financial planning that is customized to the pharmacy professional. If you're interested in learning more about working one-on-one with a certified financial planner may help you achieve your financial goals, you can book a free discovery call at yfpplanning.com. Whether or not YFP Planning's financial planning services are a good fit for you, know that we appreciate your support of this podcast and our mission to help pharmacists achieve financial freedom. Tim Baker, welcome back to the show.
Thanks, Tim. Happy to be here. What's going on?
Excited to be continuing this journey on covering some of the topics for pharmacists that are listening in the second half of their career. And we're going to do that, breaking down some of the long-term care insurance in terms of, who needs it, what does it cover, how do you evaluate different factors when purchasing a policy. And Tim, we've talked a lot about insurance on this show, health and home, auto, life, disability, but we haven't really discussed long-term care insurance in detail. And our hope is, whether someone's at the front end of their career and they're listening, just to gather some more information, learn about what this may entail, later in their career, later in their life, or perhaps folks that are in the position of purchasing these policies right now or soon to be, that they'll be able to take away an important part of the plan that probably is not talked about as enough. Would you agree?
It definitely is. And I think, even my own thoughts have kind of evolved on this. I kind of came into the industry where, we would have long-term care insurance policies in place, and, they were just, the premiums were crazy. And there was a lot of reasons why, you know, this type of insurance has kind of evolved over time. And a lot of it's like just, there wasn't a whole lot of information out there. We can kind of talk through that, but yeah, it is an important thing. And I think when with people living longer, it's definitely one of those things that I think at default, a lot of people are like, it won't happen to me, or I don't need that.
Mm-hmm.
But as we'll talk about, it is going to be a major part of the financial plan. And, there is long-term care planning with which a lot of people, it's kind of family and the money that I have, but hopefully we take this conversation a step further and we talk about long-term care insurance. So I think that's kind of the point of the conversation today.
Tim, insurance feels like one of those topics. You and I have talked about this before, that when we speak with a group of pharmacists and we bring up the topic of insurance, you can just see eyes gloss over,
Yeah.
right? And I think that's natural. I mean, who wants to think about, whether it's something like life or disability? It's not an exciting thing to think about. Same thing here, being in a place where we might need long-term care insurance, not a very rosy thought, right? And I think also just this concept of playing defense with the financial plan, even though we know it's important, it may not feel as exciting or as motivating as some of the, investing parts of the plan, for example. So this feels like, Tim, a topic that we know is important, and we've got to really translate that knowledge and perhaps have some accountability, from a planner and someone that's helping us to implement this, knowing that our tendency might be to mitigate and underestimate the risk and not focus on it as much as we do other parts of the plan.
Yeah. It's just like, yeah, anything that we kind of put under like the wealth protection, whether that's estate planning, nobody wants to talk about their premature death or what's going to happen to their kids or that type of thing, or life insurance, or even the disability insurance. They're just not fun topics. But I think we as fiduciaries, we got to have these conversations with clients and have them think about it. At the end of the day, right? Like what we're trying to do is provide options and provide a path forward,
Mm-hmm.
for them to kind of get from, A to Z, and Z hopefully is a, financial freedom in a lifestyle that works for them. But, along the way, there are, pitfalls, and, life comes at you fast. And this is definitely one of the ones where
Mhm.
it's like, hey, I wish I would have done that. And again, I think so many financial advisors themselves chalk this up to like, hey, we're just going to plan for this as it comes. But I think the way the policies are written now, they're a lot more, they're priced, I think, better. And I think they're just, they should be something
Mhm.
that are considered as part of the financial plan in general.
So, Tim, before we break down 5 key decisions that someone should consider as they're evaluating a long-term care insurance policy, let's talk through some of the background first. What exactly is long-term care insurance?
So what this is really meant, it is a product that's really meant to mitigate the major risks in retirement. One of the major risks in retirement, which is long-term care risk, which, Tim, is the inability to care for yourself. So,
Hmm.
and again, we'll talk about, what triggers this in terms of the things that you do as a part of your daily life. But, as you get older, cognitively, physically, there's a chance that you can't care for yourself. So then what do you do? And, by default, a lot of people will, kind of fall back on their family, and that type of help. So what long-term care insurance is, it's a policy that provides for a broad range of skilled, custodial, and other services provided over an extended period of time, due typically to like chronic illness, a physical
Hmm.
disability, or a cognitive impairment. So as I mentioned, the default is that a lot of people that don't have these policies, they rely on unpaid, family members. So 80% of care usually comes from, a family member, which, can be negative, to that particular family member, their own, mental health and financial resources, professional,
Hmm.
status. So about on average, there's about 20 hours on average per week is what, an unpaid family member will get. And like I said, it can negatively impact the caregiver's health and career, if that's, it's for an extended period of time. Probably not Probably unsurprisingly, I would say, Tim, the top reasons that long-term care really is needed is due to Alzheimer's. That's the number one. But the second one kind of surprised me. Arthritis was the second one, and then cancer, stroke, and then the fifth one was nervous system conditions. So
Hmm.
this is the insurance really is a product that is meant to pay out. Typically, it's a monthly amount to the insured to be able to basically paid for paid care. Whether that's skilled or unskilled, and we'll kind of talk about that in a bit. But
Hmm.
that's really what long-term care insurance is.
I think, Tim, the classic example I always think about here is Alzheimer's, right? As you mentioned, number
Hmm.
one on the list, right? This is the condition that many of us probably have had a loved one, that we're familiar with. You see the impact in terms of the progression of the disease, the level of care that's needed,
Yep.
both financially and time, as you mentioned, caregivers within the family. But also, unlike some other conditions that may have a shorter lifespan, folks with Alzheimer's can live a longer period of time, in a state where there's a lot of care that's needed. So, I know personally that's what I often think about in terms of mitigating the risk financially to my family or my boys as they get older. If Jess or I were to have Alzheimer's, that seems like the classic example where, wow, there could be a long period of time where care is needed, both financially as well as the time intensity to provide that care.
Yeah, I mean, I think that's, and we'll talk about misconceptions, but I think that is dead on. And I think when most people think about long-term care, though, they think about, being stuck in a nursing home, it
Right,
being
right.
really expensive, which is true. But a lot of the industry, what we're really trying to pivot to is kind of that aging in place. And a lot of these policies, that we'll talk about more is, the insurance companies, they recognize that the cheapest way to age is to age in the home. So they're going to do
Mm.
whatever they can to kind of keep you in place. So whether that's ramps, handles for your shower, things like that. A lot of these policies have these written in as almost like add-ons, because the longer that you can stay in
Yeah.
home and age in your home, the better. And I think that's the direction that planners should really go, is at a minimum provide a benefit that really allows you to age in place, age in your home
Mm-hmm.
as long as possible. So you don't have to, be in the nursing home, and that's where care gets really expensive, and probably from a cognitive, mental perspective, the
Yeah.
patient not in as good a place. So
Tim, you talked about common misperceptions. What are some of the main ones that you see around long-term care insurance?
yeah, I think one of them is that Medicare, we kind of talked about this with Social Security. Social Security can, it's going to pay for everything. We're good. We've been paying
Mm-hmm.
into this all our life. We know that's not true. Another one is that Medicare is going to, hook me up if I need to go into a nursing home, or even some, agent in place benefit. And that's really not true. The Medicare, it's not necessarily meant to cover any kind of care that's long term and chronic. So this is where you really have to kind of either, again, self-insure or find your own policy. Now, Medicaid, Tim, is
Mm-hmm.
is there to help people in that regard, but that's where you have to kind of be destitute. But there are strategies that are out there where people will spend down their dollars to kind of qualify for Medicare or
Mm-hmm.
Medicaid if they need it. So the first one is Medicare really doesn't cover you for long term care coverage at all. The second one is roughly. So one of the things is that a lot of people recognize this as a concern. Just like you said, you're talking about the boys and Jess. Long-term care is a retirement risk and a concern, but it's definitely
Mm-hmm.
one of these things where optimism bias, takes hold, where it's like, that's a concern, but not for me, because
Not
it's going to
me.
happen to somebody else. So roughly 60% of the US population will need long-term care services. And if you're 65 today, 70% of people 65 or older will need long-term care services. So this is more
Wow.
than the majority, right? So like that's
Mm-hmm.
important to understand. And again, if you think about it too, because of medicine, we and advances, like, we're living longer, but sometimes we're living longer with a chronic illness that we need some help. So there's a lot of reasons why I think this number will continue to go north. Um,
Mm-hmm.
and the last one I would mention is that most believe that long-term care insurance is too expensive, or just like we talk about with things like education planning, we need 100% solution. We have to have all the bells and whistles, that the care is only provided for you at a nursing home. And in reality, again, what we're trying to do is to establish a policy that pays for care in the home. And a lot of the policies now, they used to distinguish between what kind of care you were receiving, but to simplify it, if you qualify for care, whether it's nursing home or skilled or whatever at home, it's still going to pay that
Mm-hmm.
amount. So they've kind of streamlined these policies that to make it easier to understand. So at the end of the day, you don't need 100% solution, even if you can put yourself in a position where the benefit that you're receiving is essentially a 50% coupon. Like, we'll take that at this point, because that just
Yeah.
makes things a lot easier. So those are some of the misconceptions that I think people have with regard to this type of insurance.
Tim, I want to dig a little bit deeper on a comment you made about optimism bias that I think really gets at the prevalence and the need, right? Anytime we're looking at an insurance policy, whether it's long-term disability, term life types of policies, you're doing this risk evaluation
Sure.
of, what's the cost of the policy, what's the potential benefit of the policy, and what's the likelihood that I'm going to need it. And I think early on, I remember learning a lot about long-term disability, and I was caught off guard of, wow, the statistics from the Social Security Administration around the percentage of people that have a disability at some point in their career is much higher, than I would have ever anticipated. And I think that speaks exactly what you said of, hey, well, I'm, relatively young, getting ready to turn 39 tomorrow,
Happy birthday.
relatively young, have been relatively healthy, and therefore, I can't really visualize a scenario where these policies, may be enacted. And hey, I could use these dollars elsewhere in the plan. So, same thing here. And of course, we have to mitigate that risk. We have to put that risk into reality, and that's where I think a third party and a coach and a planner can really help. But break this down here. Like, what is the true prevalence and need, and what's the dollars we're trying to mitigate against here in terms of cost?
Yeah. So when we talk about the need, we said about 60% of the US population will need long-term care. What's interesting though is less than 10% of people age 65 and older have a long-term care insurance policy.
Wow.
So yeah, and we said, the stat for that was, approximately 70%. So we have 10%
Mhm.
that have it, more than 70%, age 65 and older are going to need long-term care insurance. So obviously there's a huge gap there. Um, Men and women are different. So the average care needed for a man is about 2.2 years. So they'll need, once they kind of trigger that policy, it typically pays out 2.2 years. For women, it's quite a bit longer, 3.7 years. So this is where, when if you're a woman and you have a partner, a male partner, this is might be where you link your policies or have a shared policy, which you can do. So
Mm.
um, it kind of mitigates maybe, buying a policy that'll cover you for 4 or 5 years.
Mhm.
20%, so 1 in 5 will need care for 5+ years. And again, I think some of these numbers will continue to go up. So there's lots of, and it's going to be dependent on your area of like where you live, because every state's going to be different in terms of how much care costs. But one of the metrics that we use, and this is the 2019 metric, so it's a little bit dated with pre-COVID and
Mhm.
obviously inflation being what it was. But a semi-private room in the U.S. For a nursing home costs on average $90,156 a year.
Sheesh.
So but again, if I'm looking at policies, I'm probably looking at, okay, what will it cost me for um someone 5 hours a week? And we'll talk about this when we talk about breaking down the policy. Five
Mhm.
hours or 5 days a week, 8 hours a day, some type of skilled or intermediate care. What does that
Mhm.
cost? And then build it from there. So there's levels, there's shades of gray here, Tim, is what I'm trying to say with regard to,
Yep.
we don't necessarily even need a policy that pays that 90K. But maybe a policy that, again, focuses on, aged in place, that will have
Yep.
people coming to the home to assist. So that's kind of the gist of it.
So Tim, when we look at these long-term care insurance policies, my mind is going down a path of like, well, what does it cover? And you've alluded to a couple things, and really like what triggers a policy to pay out. Again, we think about this with long-term disability, and we think about, okay, what defines a disability? And there's some considerations around that, and when would the policy actually get paid out, and what things should we be thinking about? So same thing here. What triggers a policy to pay out, and what's it tend to cover?
Yeah. So the big things that to remember with a long term care insurance policy is what's called an ADL, an activity of daily living, and they've actually modified this recently um, with IADLs, which is related to cognitive function. So an ADL, to go back to that, that is things like, can you on your own bathe, dress, keep up
Hmm.
personal hygiene, use the bathroom, maintain continence, eat, kind of walk around. They call mobility inside the house, transferring in and out of a bed or a wheelchair. So typically, if you can't do two or more of these things, this is where a policy will trigger. For an IADL, like this is more of a functional thing. So these could be things like, shopping for personal items, managing your money, using the phone, preparing a meal, managing medication, or doing housework. So, um, if these ADLs are kind of in question, then what happens is that you'll have an assessment done by a professional that will say, hey, this person needs care, and then the policy will start paying out per the kind of the
Hmm.
contract language of the policy. So some people, they need skilled care, kind of right away, where it's kind of 24 hours a day, and that's typically if there's more of like a medical need. Sometimes if it's
Hmm.
more, some of the bathing or some of the cognitive things of like help paying bills, it might be an intermediate, so a couple days a week type of thing. So really the skilled versus intermediate care is really going to come down to frequency of how much is needed. And that's where an assessment will be done on the person to see, okay, what is actually, what needs to happen in terms of people coming to the house, or or it could be moving to our facility to get the right care needed.
Tim, before we transition to the second half of this show, we're going to break down some considerations when selecting a long-term care insurance policy. And we'll talk through 5 specific things here in a little bit. But I think this is a chance, and I didn't plan for this in the notes, but it just came to mind as you were talking. This really highlights an area where having a fee-only financial planner can be really, really valuable, right? So someone who is helping you evaluate a policy for, hey, what do you need? What are perhaps some things you may not need? What does the rest of your financial position situation look like? Is self-insurement a possibility? Is it not? And then ultimately, when you decide if you're going to purchase a policy, again, helping vet that and kind of cut through some of the weeds that can often be there in the insurance space, knowing that they aren't making money off of recommending that policy. So, again, I think one of many reasons we see value in the fee only environment where, someone can really objectively look across your plan and that there's really, we'll never say no bias, right? There's always bias
Yeah.
involved in any decision conversation, but you're really where you can mitigate those
Yeah, I
biases,
think
right?
anytime that you can separate, the sale of a product from advice,
Yeah.
that's a good thing. Now, Tim, I would say that a lot of these policies aren't being sold, and I think a lot of that, it's funny because Lincoln Financial did a survey on advisor attitudes about long-term care, and 99% of advisors think it is essential for families to discuss long-term care. However, only 50%, 57% of advisors say they talk about it with clients. And I can understand
Mm.
why that is. Again, from my own perspective, it's like, hey, when I was around long-term care early in my career, it was like, man, these premiums are going up every year. It's just it
Mm-hmm.
almost feel like your health insurance. Every year open enrollment, it's like, it's everything's getting more expensive. And again, I think because of lack of data, but I think because of the low interest environment, because people were not lapsing on these policies, all these reasons were why these policies were not good. So I think people were like, advisors were a little hesitant to bring it up. Now,
Mm-hmm.
again, long-term care planning should always be discussed. Insurance, I think we're back to a place where these policies should really be considered. So, um, yeah, I definitely can see why that is the case. So, but it's interesting because again, we believe that anytime that you can separate the advice from the product
Yeah.
and the commissions involved, that's a good thing.
So, Tim, as we look at mitigating this long-term care risk,
Yeah.
you mentioned that at the beginning of the show. Really, there's two big buckets that I see. One is the potential to self-insure, and then the second is obviously to purchase an insurance policy that helps to provide that protection. And it feels like, just based off of what you shared so far, that perhaps we have the pie chart a little bit backwards in terms of the number of folks that may need the policy relative to those that actually have a policy, meaning that a majority of folks are likely self-insuring now, when in fact, maybe that should be the other way around. So talk to us about self-insure. Does that make sense for some folks, and how would that be evaluated?
Yeah. So I think the biggest thing when it kind of goes back to like, what are the goals and what's the balance sheet look like? So to me, that this is the conversation. If we are self-insuring, like, what are the sources of funding that we could tap
Mm-hmm.
into, in kind of the break the glass scenario. So obviously looking at the balance sheet with all your assets on the left, all your liabilities on the right, and then understanding, okay, these are, and again, by default, we're obviously talking about things like cash accounts, retirement accounts, um, allocating the Social Security check in that way. It could be, you know, how do we allocate home equity? There could be government programs out there that do assist, depending on the state and where you're at.
Mm-hmm.
But that's essentially it. Is like the self fund is, and then obviously the social side of it is, do you have family members that
Yeah.
can care for you, that can help assist with this and the like.
Mm-hmm.
Um, the hybrid approach, which is technically probably not self-funded, but a lot of insurance policies like a life insurance now have asset-based or linked policies that will provide some type of like rider for long-term care. So
Mm-hmm.
although they're not primarily focused on that type of coverage, there are more policies that do offer that. Or even like annuities. Sometimes annuities have long-term
Mm-hmm.
care provisions. So that those are essentially on the table. And then finally the backup for plan for self-funding is Medicaid. So when the money's gone,
Mm-hmm.
you're kind of at the behest of the Medicaid program,
Mm-hmm.
and to provide kind of the care that you need. So yeah, so I think the big parts here are, what's your balance sheet look like? Where is this money going to come from for long-term care? And then probably where's the
Mm-hmm.
family going to be in this whole picture, are the kind of the two things that I would focus on with regard to
Mm-hmm.
self-insure.
So for the rest of our discussion, let's assume that we're going to evaluate and decide to purchase, long-term care
Mm-hmm.
insurance policy. Now it's really down to, what are some things that we should thinking about? So 5 key decisions to consider when purchasing a policy. Number one, Tim, which I think is probably top of mind for everyone, is when, right? I've heard generally mid 50s, but that feels like kind of that blanket advice of, is that for everyone? So when should someone be looking to purchase the policy, and why is there potentially this window of time where it's optimal?
Yeah, so probably the conversation should start happening, believe it or not, Tim, in the decade that I'm in, that you are not in, is in your 40s, in your late 40s. So I think that's probably when the conversation should start happening, amongst family members, or even your advisor. To purchase a policy, probably you're correct, in your 50s is preferable. The average age of a purchase for long-term care insurance policies is 57, so that seems to be the sweet spot. Once you get into your 60s and 70s, the number of people who are denied coverage quadruples, and that's typically because um, things like prescription medications for this ailment, or that ailment kind of
Mm-hmm.
increase. Um, so you're either denied coverage because of things like that, or the policies are just that much more expensive.
Mm-hmm.
So yeah, I think conversation in your late 40s, and then start putting the pieces together in your 50s, and to get a policy in place that at a minimum to cover kind of
Mm-hmm.
that whole Asian in place idea. So that's kind of where we're at.
So at a broad level, we're trying to, play this dance between, too early, maybe a higher likelihood of getting coverage, but obviously paying premiums for a longer period of time. And there is potentially a
Sure.
too early. And then, as you mentioned, maybe a too late, where the amount of people that are denied coverage, goes up. So finding that sweet spot, and then taking a step back, as you already talked about, how does this fit in, with the rest of the plan in terms of cash flowing that policy. Tim, number two is choosing a monthly benefit, in terms of 5 key decisions to consider in purchasing a policy. So, how does someone start to really determine what is the monthly benefit that I need? And obviously, that's going to feed into what that policy is going to cost.
Yeah. So I think at a baseline, we should consider a benefit that covers the typical costs of like care in the home. Um,
Mm,
since again, that's 80% of where care is provided. So if we say we need someone to come in to help 8 hours a day, 5 days a week, we think that on average, and again, some of these numbers might be a little bit dated, but we'll say we need a benefit that pays out $5,000 to $6,000 per month, because that's the average care of a cost for care like that. Um,
mm-hmm.
that's I think where I would start, and I would look at it as a monthly benefit. Again, back in the day, they had, if you needed care, on this day they would say, okay, you have a daily benefit versus a monthly benefit. Most people look at this as a monthly benefit, so we're looking at
Mm-hmm.
$5,000 to $6,000 per month to kind of
Okay.
provide that baseline. So I think that would be where I would start.
And, hold that thought. Obviously, this isn't advice. There's lots of factors that are going to go into what exactly is that number for you. But hold that number in mind in terms of benefit of 5 to 6. We're going to come back at the end and talk about a couple of case studies
Yeah.
and just kind of ballpark what these policies might cost to get a benefit, near or somewhere around that level. Tim, number three is choose a deductible. So talk to us about making this choice, and how the elimination period factors in, and what that means.
Yeah, so just like a disability insurance policy, your deductible is paid in time, and the time period is called the elimination period. So once someone kind of assesses that, me as the insured, I need help with one of the eight or two or more of the ADLs, um, that's when the clock essentially starts. So let's
Mm-hmm.
say it is January 1st. then if my elimination period is 90 days, then essentially if it's on a calendar day elimination period, then I start receiving my benefit April 1st. So 90 days have elapsed. The other thing, it could be written as a service. It could be a service day elimination period, not a calendar elimination. So a service day is if I'm only deemed that I need 3 days of care per week, and I have a 90-day elimination period, that could take substantially longer, to
Mm.
basically get that benefit. So if we're trying to if we're trying to get care to stay in home, I think sooner is better. So, I think a 90-day elimination period is probably a good baseline to use. Um, so that's kind of how I would look at that, as it's the time that you have to wait for that benefit to be paid out. You pay your deductible in time, not necessarily dollars.
So we talked so far, Tim, about when potentially to purchase a policy, how to choose a monthly benefit, how to choose a deductible. The fourth consideration is deciding how long the benefit will be paid. Again, we keep coming back to long-term disability. The time length of the policy can vary, and here we're talking about the same thing, which is what's the potential total bucket of the money that's needed. So tell us more about how to consider this. This seems like a hard one to predict.
Yeah, it is. And again, if we look at kind of the average stay, and we say like a female needs 3.7 years, then we might
Mm.
price a policy out for her that's 4 years, 48 months. So we take that as kind of our number of months, and then we multiply it by, we're going to say we need at least a $5,000 monthly benefit based on how much that you know 5 days by 8 hours cost in the area that I'm living in. So 48 months times $5,000 is a $240,000 bucket. So essentially, that is kind of the money that you're drawing on. So you know that's the way that I would think about it. And I think a way to kind of really drive down costs is if you're a couple, and you don't even have to be a married couple, but if you're a couple, you can kind of connect the buckets with a rider. So again, if I'm
Mm.
if I'm thinking as a male, like, oh, I don't really need this, I can essentially leave my bucket to Shay, as kind of a contingent plan when I kind of pass away. So that rider allows you to kind of link your buckets together. So it's an N of two versus an N of one, which is a beneficial thing when we're looking at how long the benefit will pay, the individuals on the policy.
So Tim, would that be like I have a policy, Jess has a policy, and then we both have a rider that links them, or is that the strategy of like one person has a policy and the other is linked, but they also don't have a
It's
policy?
more the
How
second
does that
one.
work?
It's like you kind of are both named on the one policy, and
Okay.
then it's a
Got
kind
it.
of a shared bucket for kind of your gender and age.
Yeah. That's cool. I never heard of that before. So
Yep.
learn something new today. It's
Yeah.
awesome. All right, number five, which is timely considering inflation, and as well as we just talked about, some of the inflation protection and the benefits of Social Security having that provision. So number five, determining whether or not we need inflation protection on a policy. So Tim, is this worth the additional cost? How does someone evaluate this?
This is probably one of the most expensive things on a policy, because then, as you can see, especially year over year, how much inflation we've kind of experienced. So this would be probably one of the first things that I would kind of downgrade from a policy. Um, if you look at home care cost, the usually it's about 1 to 2% per year that it's gone up, believe it or not. So there might be where you're not necessarily linked to like a cola, but it's a flat 1%, 2%. That known quantity of one or 2% or whatever you select is a lot easier to be priced into a policy versus an unknown,
Mm-hmm.
inflation that we just don't know about. So that would
Mm-hmm.
probably be where I would cut. Obviously, it diminishes your purchasing power in the future, but it's usually one of the things that drives the premium up in a policy. So I would say that might be if you get the sticker shock with, wow, that's a lot with the inflation protected. I would price it without it, or price it with a moderate, 1 to 2%, and then
Mm-hmm.
see how that affects the price.
And hope we don't have 8%, right? Inflation long
Yeah.
term.
Although on the flip side of that, typically a higher inflation market is better for these insurance companies to keep these policies. That was one of the things that they had thought that the inflation was going to be higher than it was, but because a lot of this has to be secured. They're very like how they're investing this money is very conservative. So if you're paying
Oh, yeah.
7% versus 2.5 or 3%, it allows.
Mm-hmm.
So it should be a little bit of a benefit to the policy holder because the
Mm-hmm.
premium shouldn't be as expensive in a higher interest rate environment, if that makes sense.
Mm-hmm. Yep, absolutely. Tim, let's wrap up with a couple examples where we can start to bring this to life with, individuals at certain ages and how much benefit they may need and for how long, and then what that might actually look like in terms of premium costs throughout the course of the year. So you want to talk us through a couple of these?
Yeah, so I really have a kind of an example that shows a couple. So one of the studies, I don't know if this was Lincoln as well, but they kind of surveyed couples and asked like how much they would be willing to pay for long-term care insurance, and the number was right in that kind of $2,500 to $3,000 per year. So
Mm-hmm.
the example that I'm going to show kind of shows around that $3,000 like premium. So if we have a 55-year-old couple in this first plan, they have that shared care, so it's a linked benefit. It's kind of a regular rate. So just like life insurance, you could be preferred, which is kind of top of the line. Regular rate is kind of your of kind of average health. Um, if we're looking at a $9,000 per month benefit with no inflation rider, there's 4 years of coverage, so essentially two per person. But again, it's linked. That gives us basically a $460,000 gross benefit, and the premium for that is just under $3,100, $3,094 per year. So
Hmm.
again, if I'm looking at this couple and I'm like, hey, there's no inflation rider, but you get $9,000 a month for 4 years, it's almost a $500,000 bucket. Like, is that worth $3,100 per year? Studies show that most people would jump at that. If,
That's lower than I would have thought, to be honest.
hey, when I was learning about this too, like learning about this, me too. Like I was kind of floored by that.
Yeah.
Um,
Is that fixed or does that go up? The policy
it can go
can
up,
that
like
rise?
the premium can go up, but I think because of so like back in the day, this policy might cost like half of this. But then because we didn't have the right data and all those reasons that we were talking about, like the premium will go up substantially. We're not seeing that as much in terms of the huge jumps in
Okay.
premium, um, because of again, they miscalculated the mortality and the morbidity risk back in the day. The lapse assumptions where they thought that you know 5% of policies would lapse was closer to like 1% back in the day. So now
Mm-hmm.
because of the information is a little bit better, you shouldn't see that jump in coverage. Now that is one of the benefits, Tim. We talk about one of those hybrid policies with like a whole life policy. Those premiums are set. So one
Mm-hmm.
of the things that is the advantage to the hybrid policy is that you don't have those jumps in premiums that you would potentially in a more of a traditional plan. But I would say that because they're priced a little bit better from the jump, you're not going to see
Yeah.
that. So that's the policy without that inflation rider.
Tim, I'm wondering if many people are kind of having the thought I am in the moment as I look at this and I'm kind of seeing this for the first time as you're talking about it and we prep for the show. Like that is lower than I would have anticipated for more benefit. I mean, you talked about some, ranges, kind of a baseline floor, not advice, but generally speaking, $5,000 to $6,000 per month. This policy here, if I heard you correctly, was a little bit higher, right now, 9,000 per month. Didn't have an inflation rider, but it did have that benefit, between the couples that you talked about. And that doesn't seem crazy high. And so I guess what I'm wondering is if many folks are listening, like myself, that have parents either in or nearing retirement, like, hey, maybe this isn't a decision for me right here in this moment, but hey, what about my parents? Like, are they adequately covered? And do they have maybe some of these common misperceptions around long-term care insurance? And should I initiate a conversation, right? It's reminding me back of when we had Cameron Huddleston on the show who wrote Mom and Dad, We Need to Talk, all about engaging in financial conversations with our parents. They may not be comfortable, but if I think about where the care often may fall financially and time, on the children, like selfishly, like, should this be a conversation we're
Well,
initiating?
yeah, and a lot of the conversation that we're having, and kind of, a lot of that based on, Cameron's book that we're having with the younger clients is obviously they need to get their own estate plan in place, but is your parents' estate plan in place? Because ultimately that's going to affect you. The same is true
Yeah.
for this.
Yeah.
So, although, my parents have always told me like they never want to be a burden and put me out on the ice float, like that's fine with us. At the end of the day, like we're not going to not care for our family, or we're going to do
Yeah.
the best we can to kind of either in time or dollars to make sure that they're okay. So, yeah, I mean, it's definitely something that, it's a conversation that we should have. And then that's so much about
Hmm.
financial planning. Most people probably not even on the radar. And as a professional, I would say 2 or 3, 4 years ago, this wasn't on my radar just because of the experience that I had with policies, early in my career. But
Yeah.
to me, I think it's important to at least have the conversation with your advisor, with your loved ones about, what are the options.
Yeah, and I guess what I'm thinking about here, and again, somewhat selfishly, and shout out to my parents who have done an awesome job, both tidying up this part of the plan as well as communicating it with my brother and I, which I think is the other piece is like there's the action or the inaction, but then there's the actual conversations as well of like, is everyone aware? So we have an estate plan, or we have this long-term care insurance policy, or we don't, but are we all aware and are we having an open conversation about it? I think that's so helpful. But as I look at these numbers and we think about maybe somebody who's in their early to mid 50s with elderly parents and what may happen in terms of long-term care risks, like that could be catastrophic on their financial plan, but the amount of these policies is not
Sure. Yep.
catastrophic. And so, I think that, this is just another great example. We're actually going to bring Cameron back on the show, I think, middle of this year to have some more of these conversations about the emotional side of the plan and how do we engage in those conversations, especially when it's, with our parents. So this was a great reminder of that.
Yeah, and Tim, if I could go down, so I want to kind of use a similar example, but this is with a policy that has an inflation rider, just so you can see the difference.
Okay.
So 55
Yep.
year old couple shared care regular rate. This time they start with a lower benefit because they're going to put the inflation rider. So instead of it being 9,000, whereas the one was higher because there
Mm.
was no inflation rider. So this is $4,100 per month. Same coverage, 4 years of coverage, two per person. The starting benefit is not the 460,000; it's the 210,000. But we know it's inflation protected. So that gross benefit, when you factor that in, is a 509,000 growth benefit. But the premium for
Mm.
this
Hmm.
is just under 3,000, 2,956. So more than half or less than half of the benefits, so 4,100 versus 9,000, but the premium is about level. They're about,
Hmm.
100 bucks
Yeah.
apart. So you can see how that inflation rider can really be expensive. So it's just a matter of like, do you want to start with a lower amount of coverage
Hmm.
um, with the inflation rider, or maybe a higher amount to kind of get to where you need? But again, some of these numbers, again, surprising to me when I initially saw these.
Yeah, and Tim, as I'm looking at the numbers here in the two examples, like it's a really cool example and reminder, especially when shopping for insurance. Like design the need of what you want from a policy, and then shop accordingly versus shopping from the monthly amount,
Right.
right? Which I think is our tendency of what the budget might afford or might fit in. But here you have two examples where the yearly amount is essentially the same. It's within $100, actually closer to like 50 $60. So essentially the same over the course of the year, but two very different constructs and designs of these policies.
Yes.
So, what do you need? What do you not need? And then going from there. Tim, I suspect, so we've talked about it in kind of a siloed approach of, hey, you may self-insure, or you're going to buy a policy, but probably for many folks, it's maybe a little bit of both, right?
Yeah, I think it often comes down to kind of a hybrid approach where it might be a mix of self-funding, um, maybe some creative housing decisions in terms of, how to use equity in the house, or maybe moving in with loved
Hmm.
ones. It could be, again, what is the family support? but then at a hopefully at a minimum, maybe a baseline, a long-term care insurance policy. So I think that's often the case with a lot of things. It's not, kind of a binary, A or B choice. It's kind of a mix of a lot of things. And again, I think that's where these conversations are so important. Having a handle on the balance sheet is so important, and having a handle on what your goals are. What are the resources that are available to you to kind of allow you to age gracefully, so to speak, and make sure that, you're cared for and you're living a wealthy life. So, yeah, I think hopefully, like you said, we haven't talked about this a lot. I think it needs to be talked about more, and just figure out what is best for you and your family.
Great stuff as always, Tim. And yet another example of a part of the financial plan where, ideally we're not making these decisions in a silo, right? We're looking across the spectrum of the financial plan. You mentioned several examples throughout this episode where determining what we do or don't need with long-term care insurance, which of course we're looking at just one sliver of the whole plan, is dependent on what else is going on. And so I think just another reminder, the value of having a coach, having a planner in your corner, whether you're someone listening who's on the front end of your career and you're thinking about this way off into the distance, or perhaps thinking about this for your parents, or for folks that are in the middle of evaluating shopping these policies, we'd love to have the chance to talk with you, to talk more about our one-on-one comprehensive financial planning services, what they are, how insurance, among many other parts of the financial plan, are included in that engagement. And for folks that want to learn more, you can book a free discovery call with Justin Woods, a pharmacist on our team, by going to yfpplanning.com. We'll also link directly into the show notes, the link where you can book a call with him. Tim, thanks so much. And looking forward to continuing this conversation.
You got it.
As we conclude this week's podcast, an important reminder that the content on this show is provided to you for informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time you listen to it on the podcast. Opinions and analyses expressed herein are solely those of your financial pharmacist unless otherwise noted, and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer. Thank you again for your support of the Your Financial Pharmacist podcast. Have a great rest of your week.